Hello and welcome to Your Stocks in the Mumbai News Studio. I'm Ekta Batra and you're watching us on live from the studio at this point in time. Well, it's turning out to be a session where we have the Nifty, which is just about higher by around 60 odd points. It's been a day of consolidation, you'd have to say, but not so much for the Bank Nifty, which is down around 300 odd points. Joining us today, we have Rajat K. Bose on the technicals and Sharad Avasthi of SMIFS to answer all of your stock queries. Afternoon, gentlemen. Well, Rajat, before we kick off the show, the mandatory question to you, how would you approach today's trade?
Well, it looks as if that the Nifty is artificially propped up in the sense that if you look at Nifty Junior, if you look at the CNX mid cap, if you look at Bank Nifty, all of them are Bank Nifty and the Nifty Juniors are down by Bank Nifty 0.58%, Nifty Junior 0.15%, and CNX mid cap is marginally up. Whereas if you look at the Nifty, it is actually on a day's high. So there is definitely some kind of an artificial propping up of the index. This can sustain even throughout the session, and because you see, if Nifty has to remain bullish and get past the 4th of June with a bullishness, then it needs to take out 22,800. Once 22,800 gets taken out, then this rally will have a lot of legs because that is the key resistance zone. And so long as 22,350 to about 22,225, this support zone is not broken, you will see all dips will be bought.
Okay, all right. Well, all dips will be bought, and as of now, we are seeing some amount of traction coming in for the Nifty. Well, let's get to the first query then. We have Madhvi Lata, who writes to us from Vizag. She holds 50 shares of Tata Motors at 289. Wants to know what to do with this particular stock, whether she should hold it or sell it. Sitting on a profit at this point in time, a good profit. Well, Rajat, let's come to you first on Tata Motors. What would you recommend?
Look, Tata Motors needs to take out 1,050. Unless it takes out 1,050 decisively, which is about 100 points from the current levels, Tata Motors will not be bullish because Tata Motors is showing some kind of a distribution. However, unless it falls below 850, it won't be that bearish, because the 200-day exponential moving average has not been tested for months. So maybe the dip to 200-day moving average will happen. After that, this will resume on its upward course. That can happen. But as of now, if anybody is looking at a short-term trade, that is on the not on the long side, but on the short side.
Okay, all right. And what about you, Sharad? What would you recommend on Tata Motors and an investor's call there, sitting on a profit?
Yeah, I think the way the business has turned around has been very impressive. But going ahead, most probably the forward guidance is not that robust, particularly on the JLR side of the business. And even the cash flows could see a bit of slowdown in Q1 as well. I think next year, again, we are expecting the company to report somewhere around, 80 rupee kind of earnings, FY26 most probably. And I think 13, 14 times is more or less adequately pricing in Tata Motors. In terms of EV/EBITDA multiples also, I think they are already trading at median valuations. Not much re-rating scope is there. So I think fair value would be around 1,040. So it's better that you use the rallies that you see gradually to get out of the stock.
Okay, use the rallies gradually to exit the stock. Any alternative in the auto space that you'd recommend?
Nothing right now. We were a bit bullish on Ashok Leyland, but I think in the last 2 or 3 months, even that has rallied a bit. So in terms of fair value, if I just look at valuation comfort, where it is trading at comparable valuations which are more attractive, maybe Hero Moto would make the cut. But in terms of historically where they have traded, I think there are triggers in terms of the electric launches, etc. But across the board, along the larger players, the basically OEMs, I don't think you have any idea that that would provide 20-25% upside from current levels. So I don't think the whole auto space does make much sense from these levels.
Okay, all right. So that's on the auto space. The index itself has rallied over around 35% in the past 6 months. Let's get another query now. We have Anuraj who writes to us from Mumbai, holds 6,000 shares of Yes Bank, which he's bought at around 15.2 rupees. So he's sitting on a profit there. And he's bought it near the Diwali time. He wants to know what to do, whether to hold or sell. Well, Sharad, would you hold it from one Diwali to another?
Yeah, I think the type of news flow that is there in case SBI needs to get out and a new incumbent does come in that has been doing the rounds, the possibility is that the deal would be at a substantial premium to current prices. I think that is one trigger which could result in some re-rating. If that is not to be considered, I think it is trading at what, 1.5, 1.6 times price to book. FY25, most probably the book value would be somewhere around $15. So I think from there, it's more or less trading at fair valuation. So, but this deal happening and a change in management or a new incumbent coming in, I think that is something that could be viewed as very positively. There is a possibility that you could have strong re-rating. In that case, I think targets could be anywhere between 35 to 40 on the stock. So I think you can continue to hold. Most probably Rajat would give you a proper stop loss to hold on with. But I think, yeah, if this news does come in, it's not exorbitantly priced at 1.5 times. Forward price to book, net NPAs, etc., have been clawed down below 1%. That's a very positive development. And this new change, I think that should turn out very positive for the company. So initially, I think you should hold on for targets of around 35 rupees to 40 rupees on the stock. That is something that can happen on the basis of that deal happening. And it's not exorbitantly priced to continue to hold with an expectation of that price.
Okay, all right. So that's on Yes Bank. Technically, the stock has seen a good rally and it has really bounced from its lows. But Rajat, what would you recommend? Would you trade with caution on Yes Bank from here on? And what would your stop loss be?
First of all, the stop loss should be below 20.50. If 20.50 is taken out on closing price basis, there is no reason to remain invested in Yes Bank. Because that's a key support, that was a key level from where the bounce actually happened. And on the upside, it needs to take out 24.50 to about 25. This is a supply zone. Unless this supply zone is decisively taken out, you won't see much of an upside either.
Okay, all right. Well, let's get in another question now. We have Mayuresh who writes to us from Kolkata, holds 30 shares of Tata Steel, which is bought at around 170 rupees per share, wants to know what to do with this particular counter, whether he should hold or sell it. At Tata Steel, he's sitting on a marginal profit at this point in time, just about flat. Well, Sharad, you go first on this.
Yeah, I think I would use this rally in metals to exit. Largely, I think most of the metal stocks have become a bit overheated in terms of valuations. Specifically, if you talk about Tata Steel, I think what are we expecting? FY26 an EPS of somewhere around 15 rupees. And I think 9 to 10 times is roughly more than fairly valued for most metal companies. This China hope of a rebound has gone in very strong and there has been some recovery, but I don't think that is a sustainable one. So I don't see many triggers, positive triggers for the metal side. There are some new environmental regulations that come in place from Europe, most probably by December. So I think that could be another, headwind for most metal companies, specifically more so for a company like Tata Steel, which has international operations largely. So I think at these valuations, my fair value is around 140, 150. On the optimistic side, it's already trading much above that. So according to me, one should exit the stock.
Oh, okay. So you would probably recommend exiting the stock. And what about you, Rajat?
I would broadly concur with Sharad that it's better to exit this stock because whatever happens, it is unlikely to cross, say, 185 to 200, where there would be a lot of supply that I envisage. So it is better to take some profits, whatever that the investor is getting, and below 166. By any chance, if it were to go there, then definitely one should exit.
Okay, all right. Well, we have Mr. T.N. Jain now, writes us from Hyderabad, holds 60 shares of Asian Paints, which is bought at 3,000. Wants to know what to do, whether to hold or sell for a long-term perspective. Well, Asian paints, it seems to be the flavor. FMCG seems to be the flavor today. But as of now, Mr. Jain is sitting on a loss, so not looking good. Rajat, what would you recommend?
See, only if you look at the daily chart, then you will have a feeling that as if there is likely to be a bounce and it can go up again. But look at the monthly chart, look at the weekly chart, you will see the kind of distribution over a period of last 4 years had been happening. So I would suggest that if it were to fall below, say, something like the earlier lowest close, that was 2770, use that as a stop loss and one can hold on. But if I were in his shoes, I would have exited Asian Paints. This actually avoid paint stocks now because they are not looking good at all.
Okay, not looking good at all. Well, there is impending competition coming in. So from that perspective, what would you recommend, with the big heavyweights, in fact, throwing their ring in, throwing their hat into the ring? Sharad, what would you recommend in the paint space, becoming more competitive?
Yeah, I think that is something that's a given with the type of capacity Grasim is coming in with. And the group already has the infrastructure in terms of distribution. So it will be a challenge, but I think Asian Paints is in a dominant position. And largely over the last 3-4 years, what has happened is these stocks become absolutely priced in terms of the valuations at which they were trading. If you look at most FMCG and paint stocks, they were trading at 80-90 times forward, that is. And I think that is a bit tad expensive. In my career, I haven't seen many times people making money buying at 80-90 times. Specifically traditional businesses. So I think even in Asian Paints, that's played out over the last 3-4 years. At these valuations, I think, though the new incumbent coming in is a challenge for the paint companies, even JSW in some bits and pieces has come in. So there are two big groups that are coming into the space. Hitherto, they were the dominant players and the rest of them were very small to give them a very handsome challenge. So I think that's a challenge that will be there, but the competitive edge that Asian Paints has, that remains, and I think they will continue to reinvent the business models and everything. I have no doubts regarding the competency of the management. In terms of valuation, FY26, we are expecting the EPS to be somewhere around 60-61 rupees. With oil, we are expecting oil prices to be lower gradually over the next, decade or so. So that should be very positive for paint companies. That type of real estate demand, the type of urbanization that we are looking at specifically in India, I think that is going to be a very big driver. Your per capita incomes are growing, so most probably, the paint requirements would also go up. A lot of tier 2, tier 3 cities are coming up, a lot of industrialization happening. So I think broadly it should be very positive. They should move in sync with the broader economic growth. So Asian Paint should also benefit out of it. In terms of valuations, yes, I think 40-50 times is roughly a decent value to be given to a market leader and a steadily growing company. So considering that, if you are a bit pessimistic, you could look at targets of around 3,050. And on the optimist side, I think you could continue to hold for targets of around 3,500 because you're a long-term investor. I think that would be a more viable target to look at.
Okay, all right. Well, gentlemen, hold on. We need to take a quick break, but lot more queries on the other side. Stay tuned. Welcome back. You're still tuned into Your Stocks. We have with us Rajat, Bose and Sharad Avasthi to answer all of your stock queries. Let's get to the other one. Tejas now writes to us from Hyderabad. He holds 20 shares of Hindustan Unilever, which he's bought at around 2,291. He wants to know the prospects of this particular investment. Well, HUL is doing well today. In fact, it's one of the top gainers on the Nifty. So technically, Rajat, I just wanted your thoughts on HUL, considering that it's still an underperformer on a year-to-date basis. From that perspective, how would you approach it?
HUL recently had a similar run, in fact, even a better run a few days back. That was, I think, 7th of May. It went up from a low of 22.59 and then finished, posted a high of 2389 and closed at 2379. And now it is still trading once again at those levels, 2370. So this is, from a technical parlance, we can classify this as a bullish belt hold kind of a formation, which is a bullish formation. So HUL is likely to move up. At least it will test its 200-day exponential moving average, which is at 24.23. Once it takes out that, then it can actually have more legs. But as these prices, one should continue to hold HUL, and if one is a real long-term investor, then one can jolly well carry on with it. And HUL space is messy, but not as messy as Asian Paints now. So HUL is still a hold, fresh buy. One can do that even at current prices.
Okay, what would your top pick be within the FMCG space? How are you approaching it as a sector technically?
Well, in the FMCG space, HUL is one that you can look forward to. You can, from a similar technical point of view, I would say Britannia looks pretty good. Britannia on declines should be bought. That is another. Anything, I would only avoid ITC because ITC is not being able to come up with the kind of margins that HUL or Britannia. Another good pick in my view, two best picks in my view are HUL and Nestle. Nestle at current price, Nestle has immense pricing power as far as baby foods and stuff like that because it's more of a monopoly there. So Nestle for a long-term, with a long-term perspective, and HUL with a long-term perspective would be the two best picks at the moment. And they are the best stocks to buy now, where you should be very wary of the market movement in the month of June.
Okay, all right. And, same question to you, Sharad. One on HUL and two, what you like in the FMCG space.
Yeah, so for HUL, I think in terms of numbers, they should have decent growth over the next 2-3 years. I think 35 to 45 times is something the stock should ideally trade at. The numbers have been a bit subdued in the past because of the rural markets not picking up. But this quarter, most of the commentary seems to suggest that most probably rural markets are catching up. And I think that should play out very well for HUL as well. So there is a possibility, that the earnings could get upgraded by 10-12%. So if after 26, you expect the earnings to be somewhere around 58-60 and a 35 to 45 multiple, I think initial targets of 2,500 and then 2,700, very optimistic targets. That is what you should keep on HUL. And I think that should turn out to be a reality over the next, 1 or 2 years. Raw material pressure has also been easing, and that should continue to ease as most commodity prices come down. So all in all, I think for HUL, that should be positive. So continue to hold for targets of around 2,500, 2,700 on the stock. Regarding the other two picks, I think a very contrarian thing, I'm very bullish on ITC. And I have targets of around 550. I think one of the cheapest within the whole FMCG space. Further demergers could add more fire to the stock prices. And I think it's still trading at 25 times. Yeah, if it trades at around 25 times forward, my fair value target is around 550 on the stock. And if the market mood is good enough and the FMCG business, as they are talking about raking it up, if they can rake it up, there is a high possibility valuations could even go up higher. Even the hotel demerger is on the cards. And I think the hotel business has a very aggressive expansion plan. So that should also aid growth in the long term. And even paper, I think gradually the tide is turning again in favor of most paper companies. So ITC would be one stock within the FMCG space. It's a mix of FMCG and a lot of other businesses. And pure FMCG, I think Dabur, because they have a stronger presence in the rural belt, and rural India has seen a strong recovery, and that recovery is expected to continue. So Dabur and ITC.
Okay, all right. Well, one stock which is actually doing well is Strides, which has come out with a revenue of around 1,084 crores. Its margins have expanded to 21% versus 15.8%. And Strides Pharma should come up for you. The stock has spiked up on the back of that, up around 6.6% at this point. Do you look at Strides at all, Sharad?
I've looked at it some time back. Most probably the numbers are a bit of a big beat actually. So I need to look at more details. I don't exactly remember the recent numbers.
Okay, all right. Well, now let's get in another question. Manav Singh writes to us from New Delhi, holds 20 shares of Coforge, which he's bought at 4,000 odd rupees. and he wants to know what to do, whether he should hold or sell this particular stock. The stock is sitting with gains of around 2.8%, and Manav has made money on Coforge as well. Do you think there's more to go on this one, Rajat?
Well, I have my doubts because it is actually showing a pullback corrective rally, but the chart pattern is not giving enough confidence to see that it will cross 5,500, where its 200-day exponential moving average is located. It might go up to close to that level, but if it were to do so, then one should seek an exit from this count.
Okay, you would seek an exit from that counter then. And Coforge, Sharad, what about you?
I think the way the management commentary has come out regarding what they want to achieve over the next 4 or 5 years, that's very aggressive. And I think Coforge is a smaller company within the basket of IT stocks. And the ability and the fact that they plan to be amongst the top companies with more than $5 billion of revenues, ultimate target being $6 billion of revenue. So I think the company is gearing up for very rapid growth over the next, 4, 5, 6 years. Right now, it's less than $1 billion company, and the long-term targets are that they want to rake it up to around $6 billion. They've recently signed up with Microsoft also for some AI development, and they have a strong AI team and an AI plan also. So I think that should aid very well for them. Add to that the recent Signity acquisition, and today most probably the QIP has also been announced. If you have a longer horizon, I think hold on to the stock as a good multi-bagger kind of story, because if a business has to grow 5 times from current levels, the rest of the maths, you can also do that, what kind of improvement can happen. On the flip side, the erstwhile promoter, the PE fund, is not there anymore, and it's a professionally driven organization. And there were some red flags regarding the Signity acquisition also, because the company had corporate governance issues. But I think initially hold for targets of around 6,000 on the stock. And long term, I think you can continue to hold on to it as a multi-bagger. I think 2-3 times from current prices should be a possibility.
Okay, bullish call coming in there, Sharad as well as Rajat. That's all the time that we have. Thanks very much for joining in and taking us through all of those queries. Have a great afternoon. That's all the time that we have on the show. But do remember to email us your questions. We'll address them with our experts. Stay tuned. Closing bell up next.